Welcome back to Around the Table with Stacy Smith. We're talking about investing in the economy, and we've been talking about recession. And Bob, just before we went to the break, you wanted to say something. Go ahead.
30 seconds. A big component of the inflation push is government spending, and that's driven by congressional action and the administration. The Fed can't control that. There are significant signs that the government is not, even though some recent proposals would indicate otherwise, the government is not as prone to spend as freely as it had when it spent us out of the last Great Recession. So a slowdown on government cash programs, big expenditure programs would be called for, and that would be a big boost to controlling inflation.
All right. Now, there's no question the markets have become more volatile these days. And last week, a record was set for how much the Dow went from a low to a high in one day. It was 1,500 points. So, Frank, what is happening? Is it just something that we can expect with a bear market?
The extreme intraday volatility, Stacy, is largely a result of news bullets that change algorithms and cause computer-generated order flow to push the markets one way or another. And that kind of feeds on itself, because when the markets start changing in specific industries, then the indexes have to adjust all these ETFs have to adjust their holdings accordingly. And it creates a lot of activity that's mathematical and not really investment oriented. My advice has always been to ignore the day-to-day. Back in the early 70s, we used to have tickers in our office running through. I had a branch manager when we moved, and I was brand new in the industry, and I was responsible for the move because he didn't have time and I did. And one of the things I got rid of was the overhead of that ticker, because I said, people are sitting here falling asleep watching that thing. They're not doing business, and all it is noise. And as time has passed, that thing has even become less valuable because it doesn't tell you what the volumes are on these trades, because the volumes are so enormous anymore that it's even less meaningful for a day trader. Now, the facts are, what we're seeing is a gradual decline in the market that's been going on since, I want to say January, maybe, certainly February. And it's been eroding because interest rates are rising, and that has changed the mathematics of present value of future earnings. With the rising interest rates, future earnings are in flat out worth less. Now we've got the equation of what are the earnings going to be. And there's analysts running around trying to guess on that, and it boggles my mind at how badly they are at guessing. I don't even attempt to do that. I just look around and say, well, I think that the earnings are going to grow over the next 10 years a number, and based on what I see demographically, and I say we have to revert to the mean, which means earnings are going to come down some, depends on how fast it happens as to how low they'll go. And the present value of that, those things should be at this multiple based on history. And we probably got a little more down in the market before we turn, but that's a guess as well. I have no idea what earnings are going to be. I just read this morning that the third quarter earnings are supposed to be up 3.5%, and the fourth quarter expected to be up 5%. Now, this week we're going to start seeing earnings. I think we saw Bank of America's earnings this morning, and they were very good because their interest income rose 24%. Now, was that shocking? I mean, who was surprised by this? Interest rates went up, of course. And by the way, they're still not paying much on CDs. So they're really taking advantage of the short-term move in interest rates and not rewarding their depositors, because I don't think they really need the deposits.
It is a repeatable phenomenon of slowdown in business. Businesses cut costs. Labor could be part of it, but they also look to value engineer their processes. And they continue to do whatever business there is, but their margins widened. And that's exactly what Frank's talking about.
And, investors are always asking the question about things like we had last week, where you have these wide swings in the market, and, how do you compete with, or how do you deal with the computerized trading? We accept it. I mean, we know that it's going on. We know what impact it could have. And really throughout the day, by the end of the day, for those of us that are in this industry, we knew what was going on. So, that's really, again, why it makes sense to have professional advice for people to help you through understanding how these things work. And, as Frank said, none of us know exactly what's going to happen. That's why you have to pay attention. You have to look at the economic data that comes through and start to really hypothesize as to which way things are moving. And that can change every day.
And I know you're watching TV right now, but please don't fill your day with watching networks that are solely targeted to telling you about financial news, because you're going to be inundated with all sorts of information that the rest of us would ignore because we're professionals. We've been through this move before in markets, maybe not numerically, but we've certainly seen weird things happen. And we know what is important and what to ignore. And I'm doubling down on find yourself a professional that you can work with, and they will save you not only a lot of time and money in worrying about markets, but, just peace of mind that they have, we all have been through this before.
I'm going to take us over our time on this one again, but I do have this question. It goes back to these algorithms and the trading that takes place with these huge funds that are out there. Am I right or am I wrong that if you have a buyer, you have to have a seller?
Yes.
Okay, so if you're selling and they put sell signals in, and the market just goes tanking down, in hundreds of points almost within a matter of minutes. Are there buyers that are in that time period as well? Other algorithms that think, okay, this is where I want to jump in?
All the machines are talking to each other. That's the issue.
Yeah, there are buyers. Go ahead.
I'm sorry. Go. You both talked.
I apologize. Go ahead, Kim.
It's machines talking to each other. No human can react that fast. And that's kind of the indicator of what's really happening. Like, whenever we talk about flash crashes, that is either somebody, and I know this sounds crazy, but at a trading desk, somebody could enter a really wrong number. And that's going to be a really bad day for whoever did that. But most likely it's machines talking to one another and having a self-ugly reinforcing loop.
And they come from different philosophies. The algorithms aren't all the same. So one person's computer is selling based on algorithms, and another is buying. And I'll also point out if you go back BC, before computers, the same thing was true. Frank and I would remember that the institutional investor still drove the markets. The amount of retail trading versus the institutional is small, and it's exacerbated by the speed of computerized algorithmic trading now.
And one more fun fact about computerized algorithmic trading, oftentimes they will show a bid offer, like somebody, I want to sell this for this amount, but they'll then rescind it. And that, even just that amount, like there's no trade placed, but they can just kind of show their cards, and that can drive the prices down really quickly.
And the viewer has to ask him or herself, what does that mean to me? Why should I even care about that? And as Kim said, look past it, because that doesn't impact you unless you allow it to force you to make wrong decisions because you twisted your arteries in a knot over it.
Yeah, but if we don't have those things, people like me on television, when I was on television, had nothing to talk about it. So
we want you to be the voice of calm.
Okay.
Back when Bob and I started, you didn't spend all day talking about it. You spent maybe an hour.
Yeah. All right. I'm way over our time period here. We'll have to take another break. We'll be back in just a moment.